live. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Thursday, everybody. Today is June 26, 2025. And I'm once again coming to you live from this artificial tropical paradise. I am on vacation this week, but the show must go on. And this morning, well, we've got a story that it's probably going to have a lot of you guys shaking your heads. Now, look, we're going to dabble in politics once again. I try to avoid it. It's unavoidable this morning because we've got the dollar is hitting the lowest level that it's hit since February of 2022 this morning. And you guys may recall February of 2022, that was right before the Federal Reserve started their campaign of quantitative tightening. All right, it was right at the beginning of our supposed fight against inflation. By the way, how's that fight against inflation going? We're going to look at one very important chart to show it's going a whole lot of nowhere. As a matter of fact, it's gone nowhere since we started this whole big fight for inflation. And why is the dollar so low this morning? Why are we talking about this? Because President Trump is out there teasing a replacement for Jerome Powell. Now, he's not talking about firing Jerome Powell. We're not having the whole Fed independence argument. That has been put to bed. I don't think that's going to happen. But what President Trump and his administration is doing right now, they're touting, people familiar with the matter, all that stuff is going on. They're kind of suggesting through back channels to the press that President Trump will name Powell's replacement early, very early. Now, typically, we only name the replacement of the Fed chair within like 3 to 4 months of that new chair actually taking office. And Jerome Powell is supposed to stay in office until May of next year. So he's got quite a while to go before his term is done. Powell has made clear that he's got no intention of resigning. And, Trump so far, knock on wood, is not planning on firing him. So an early announcement of a replacement Fed chair would effectively undermine Jerome Powell's leadership for the duration of his term. It would make him a lame duck. All right. So anytime Jerome Powell says a thing, all the press is going to go to his replacement and say, well, what do you think of Jerome Powell's idea? And that replacement could come in and totally contradict him. And it would kind of be like two parents fighting in front of their children. And the investors would be like, oh, I don't know which one to believe. It would kind of make a mess of things. And of course, any replacement Trump names based on Trump's rhetoric, which has been rather harsh and rather, let's be honest, Trumpian for the last couple of weeks towards the Fed chair, it's going to be a dove that they replace Jerome Powell with. And look, President Trump has been very vocal recently about how he wants interest rates lower. He's trying to set up Jerome Powell to be the fall guy for anything that goes wrong economically. And look, you never have a politician stand in front of an economic downturn and say, yeah, this happened on my watch, right? That doesn't happen. They almost always shift the blame to the guy before or to some other thing or Putin's inflation. Remember that whole nonsense? Well, now it's going to be stupid or too late Jerome Powell. He should have cut interest rates, and that's why my stock market crashed from what is currently very close to an all-time high, I might point out. But the point is, guys, we don't need a dovish shift in monetary policy. President Trump is just flat out wrong here. And I'm not taking Jerome Powell's side. Jerome Powell's doing the right thing, but he's doing it for the wrong reason. Jerome Powell was just rushing to cut interest rates right before the election. And then, all of a sudden, a hawkish shift is when the election goes a certain direction. Oh, my God, shocked face. But right now, cutting interest rates would be the wrong thing. President Trump is demanding the wrong thing. Let's look at where we're at right now. Stocks are within striking distance of all-time highs. Gold within striking distance of all-time highs. Those two things should not happen in the same sentence, but there they are. Bitcoin within striking distance of all-time highs. Housing within striking distance of all-time highs. Unaffordable for entire generations worth of people. And of course, most of all, the most important thing that tells me we do not need a shift in monetary policy in a dovish direction is the money supply. Why is nobody talking about this? M2 money supply in the last year and a half to 2 years has grown by more than $1.4 trillion. Where TF did that money come from? And why are we sitting here pretending like monetary conditions are tight? They're not. The money supply has expanded by what is that, 12 digits? How many freaking zeros are in a trillion again anyway? I don't even remember. But money supply doesn't grow like that during tight monetary conditions. So we're talking about a dovish transition when life is already unaffordable, when assets are already insanely bloated. In other words, we're playing with that inflationary fire. And we never really fought inflation to begin with because we didn't let that bubble burst. We have done all of these cockamamie gimmicks and things to avoid price discovery to keep asset prices inflated. That has translated into a frozen solid housing market that is still out of reach for virtually all millennials and Gen Zers. And well, we're just going to make it worse if we shift back to dovish monetary policy. So I do think the president is wrong to make these demands, but hey, the market is reacting to it today. And of course, if we do get a dovish monetary policy shift, it's almost certainly going to send stocks higher because that's what dovish monetary policy ultimately does. We got a couple other big things going on this morning. Platinum is making another big move. Look, we've seen the little silver has done pretty well here these last 2 months. Once again, shout out to David Morgan and Bob Coleman, both of whom came on my channel a couple of months ago, and both of them predicted a big run in platinum, and well, they were right. That platinum drive has been partially pushed along by a shift of Chinese. The Chinese have been importing a lot of platinum, as did the United States in the run up to the tariffs and worries about the arbitrage play. But we've seen a shift from the Chinese buying up a lot of gold jewelry to buying up a lot of platinum jewelry. And that points out that gold to platinum ratio. That's something that David Morgan and Bob Coleman both talked about on my channel a couple of weeks ago. Well, we've seen that gold to platinum ratio come down pretty rapidly in the last couple of weeks as platinum has run while gold stalled out between 33 and 3,500. So I'm wondering, does this move in platinum, does it have legs or could it be about to wrap up? We'll take a look at that chart. We've also got a big move in the housing market going on right now. FHFA Chairman Bill Pulte, who, by the way, is one of the biggest home builders in the United States, a little bit of a conflict of interest there, but he wants to allow Bitcoin to be used as a mortgage asset. In other words, you'll be able to borrow against your Bitcoin when taking out a mortgage. Now, we don't know what form that's going to look like or how they're going to manage risk, but whoa, buddy, that could get messy real fast. And of course, they're talking about doing this, allowing you to use your Bitcoin as a mortgage asset without even liquidating it. So giving Bitcoin almost preferential treatment over stocks when you go to buy a house. Obviously, that will result in more money chasing houses and probably higher housing prices, but it will also almost certainly drive more demand for Bitcoin now that it becomes something else you can do with your Bitcoin, borrow against it to buy a house without even selling it. That's quite amazing. That came out yesterday. We've got Micron earnings came out last night after the bell. It was a big beat driven by AI demand for high bandwidth memory. So the data center bubble build out that continues. It's driving Micron shares higher this morning, but just barely higher this morning. Micron shares were a lot higher last night. It's now given up almost all of those gains. And we've got the New York Socialist mayoral candidate, ZOC, as I like to call him. He is possibly going to rekindle a banking crisis that was just narrowly avoided at the beginning of last year. Got a name we haven't talked about in a while on this channel. We're going to look at that one and what it did yesterday after the Zohan won the big mayoral primary in the Democratic Party yesterday. And well, yeah, communists running New York City. Who had that on their 2020s bingo? We've got China is dragging their feet on rare earth metals exports. Remember that whole blow up, the second blow up with Trump over Truth Social, and how, first we had the big 145% China tariffs, and then they went away. We had a deal, and then a few weeks went along, and there was another Truth Social post, and the tariffs are going back to 145%. And then they're like, oh no, there was another deal, and then we went back to like 55%. Who's keeping track? Well, it seems the Chinese are just still not sending the rare earths that they agreed to, or at least the ones that they're sending, few and far between. It's just a reminder that we're only ever one Truth Social post away from another skirmish in this global trade war that's still going on, and the market just continues to ignore it, even though it's sitting over there like the 500-pound gorilla in the room. And last but not least, BlackRock is once again talking about how private investments are going to be democratized for the masses. In other words, they are looking to make your retirement into their exit liquidity, and they've got a shiny new vehicle with all kinds of high management fees with your name on it. They're still trying to offload that crap into your retirements. And it's funny because this Wall Street Journal article talking about this morning, it makes no mention of the fact that the reason they're doing this is because they can't find anybody else to buy it because they've already done every trick under the sun to avoid liquidating this crap and avoid having to market to actual market values. No, they don't talk about that. They're just talking about private equity for the masses. We got a lot to talk about this morning, guys. Why don't we shrink my big melon of a head and let's see what is happening in the markets. And hey, this is a reminder to please hit that like button and that subscribe button because we do this every day, whether I'm on vacation or not. We'll be back in the studio next week as regular. And also hit that subscribe button so you can come back and have your coffee with the melon heads tomorrow morning. Right now, the S&P 500 is positive for the day, up about 1/3% or 19 points higher, still within striking distance of an all-time high for the S&P 500. We've got the Dow is higher as well, 0.28% in the green this morning, or about 120 points to the upside. And we've got the NASDAQ rounding things out, up 78 points or 0.35% higher. So stocks are up pretty much across the board once again this morning. But this is the big story here, the DXY. Look at the dollar, down sharply once again, 97.29, lower by 41 basis points. And at one point overnight, we went as low as 97.0, 97 flat. We went to a 97 even. So a little bit of a psychological resistance there, maybe caused some buying in the algorithms. But hey, let's look at a long-term chart of the DXY here, guys. We're looking at weekly candles for the US dollar. And now again, the Dixie, not the best indicator in the world. It doesn't measure the amount of stuff the dollar buys. It measures how many euros the dollar buys or how many yen the dollar buys, right? It's the dollar divided by a basket of other global currencies. But you can see here the DXY has been falling quite a bit, pretty much since January in the lead up to Trump taking office. We all kind of knew Trump was going to push for dovish monetary policy, and he was pushing for a weaker dollar in order to make U.S. exports more competitive. So I understand why the dollar is falling here, but it has fallen quite rapidly. And if you look at the last time we were at this level was Monday. These are weekly candles. So it was the week of February 28th, 2022. And that's interesting because it was March of 2022 when we began our campaign of quantitative tightening and interest rate hikes over at the Fed. So the dollar is the weakest it has been since pretty much the peak of the inflation hysteria. Again, dollar is the denominator in the price equation. So the dollar getting weaker, that is going to put upward pressure on the price of everything, housing, stocks, bonds, gold. A weaker dollar is good for their prices. Now, looking over at the bond market, we've got not much movement going on this morning. The 30-year Treasury is down by 1 basis point, 4.831% for the 30-year. The 10-year's at 4.263. That's off by 2%, almost not 2%, by 2 points, almost 3 points there. The 2-year, meanwhile, 3.746. That's off by 3 points and change. And the 1 month is at 4.110, higher by about a half a point. Not a lot of movement in bonds, despite the big move in the dollar. Now we've got spot gold is a little bit weaker here this morning, down by about $10 or 1/3%, $3,322 for spot gold. Spot silver is getting a little bit of buying this morning, $36.45 for spot silver after briefly trading under 36 yesterday. That's higher by about 18 cents or a half of 1%, and I like the shiny. Meanwhile, copper is up by about 2.9%. Platinum is higher by 4%. Look at platinum futures, $1,382 for July platinum futures. We hit a high overnight of $1,411, almost $1,412. Put a pin in that platinum. We're going to look at that chart in just a minute here. What else we got this morning? Palladium is higher by 3.1%. I'm sure that platinum price is starting to exert a little bit of a pull on the palladium price as they're interchangeable for automotive uses. And we've got WTI crude is 1% higher as well, $65.63 for crude oil. But we've had some quiet in the Middle East for a couple of hours now, so oil should be calming down here. Now, let's talk a little bit about this one in Bloomberg here, talking about platinum. We've got platinum jumps to the highest since 2014 on mounting supply concerns. This one was dated yesterday evening. Platinum surged to its highest level since 2014 as supply concerns and a wave of speculative buying jolted the market. The precious metal surged as much as 4.6%, while palladium was up more than 5% at one point. Gold edged higher as investors waited for clearer signs that the Israel-Iran tensions won't spill over again and for more certainty on the Federal Reserve's interest rate path. The recent surge in Chinese investment and jewelry replacement is shining a spotlight on platinum's supply deficit. Now, that jewelry replacement is important. That is because gold got so expensive so fast, the Chinese were buying up gold jewelry like crazy, that some of them started shifting to buying platinum jewelry, which meant that gold to platinum ratio was becoming a major factor here. We'll look at that chart in just a second. Palladium and platinum are intrinsically linked as they can be substituted for one another for use in auto catalysts depending on relative prices. So we can expect to see some positive momentum in palladium off of platinum's rally. We've seen that this morning. The dominant platinum spot market in London and Zurich has shown signs of tightness for months after approximately 500,000 ounces surged into U.S. warehouses, spurred by a lucrative arbitrage and fear of tariffs. Forward prices for platinum are now trading well below spot, a situation known as backwardation, which indicates tight market conditions. The implied cost of borrowing the metal is also still high at an annualized rate of roughly 13% for a 1-month lease, well above the usual rate of close to zero. So a little bit of a supply shortage there, possibly a supply squeeze happening in platinum. Backwardation is a pretty good indicator of that. Now, I wanted to show you this chart here. This is the gold to platinum ratio, or the number of ounces of platinum it takes to equal the price of 1 ounce of gold. Now, this was one of the charts that David Morgan and Bob Coleman were talking about on my channel a few months ago. And, that was before this recent downturn, because we have seen platinum run like crazy these last couple of weeks. And as that has happened, we've seen this gold to platinum ratio come down. And that's important because of that jewelry switching that was going on in China. I just want to kind of reiterate that we're now back to pretty much the gold to platinum ratio we were at in July, pretty much a year ago last summer. Now, still historically a high gold to platinum ratio. The gold to platinum ratio has done nothing but rise for pretty much 25 years. But the point is, we have seen a pretty rapid correction in this ratio here. So I wonder if that Chinese switching from gold to platinum, is that going to continue now that the two metals are a little bit better in balance? Maybe that means gold is going to resume its upward momentum and that this run in platinum could stall soon. Just something to keep an eye on there. And of course, while we're talking the gold to platinum ratio, let's talk about the gold to silver ratio as well. Currently sitting at 91.16 or 91.1, we'll say. Silver still historically undervalued relative to gold. So that tells me we could see silver, possibly platinum, continue to outperform gold for a short time. And then eventually, I think we'll probably see gold resume its move higher as the world continues to move towards dovish monetary policy, which should be rocket fuel for gold prices. All three of the metals probably going to do pretty well here. All four. Let's include palladium while we're at it, because if platinum's price rise, you'll see switching to palladium for catalytic converters, and so that's going to bring that price up as well. Now let's look at Bitcoin real quick here. We've got the price of Bitcoin is currently $107,080. Is priced on Coinbase, pretty much unchanged from yesterday morning. Now, we had an interesting story about Bitcoin yesterday. This was from FHFA Chairman Bill Pulte. Trump administration moves to count crypto as a federal mortgage asset. Now, look, guys, I like Bitcoin. I own Bitcoin. I buy it on the regular. This is very risky what they're talking about here. Like, I like Bitcoin with the full understanding and acceptance that Bitcoin carries with it a rather high risk return volatility profile, if you will. Borrowing against it to prop up housing. That is the stuff of that. That is a wild man coming up with this idea. Let's face facts here. In a landmark shift for U.S. housing finance system, the Federal Housing Finance Agency has issued a directive ordering Fannie Mae and Freddie Mac to formally consider cryptocurrency as an asset in single-family mortgage loan risk assessments. The move, signed by FHFA Director William Pulte, who builds houses, by the way, on Wednesday, signaled a new era of crypto integration into traditional financial infrastructure, this time within the core of American home lending. The order directs both housing finance giants to develop proposals that include digital assets without requiring borrowers to liquidate them into US dollars prior to a loan closing. That is mind-boggling. Without requiring liquidation, which means you're allowed to hold Bitcoin basically as collateral on a loan somehow. I mean, we don't see the fine print here, but if you're not requiring liquidation, that means you're allowing that asset as collateral. We don't even do that with stocks. And stocks are risky. Bitcoin is riskier, in my opinion. I like Bitcoin because I think the reward profile associated with Bitcoin justifies that risk, but let's not pretend that risk isn't there. It is. That is crazy that we're talking about allowing them to do this without liquidating. Now, the directive restricts consideration to digital assets that are stored on U.S. regulated centralized exchanges and can be clearly evidenced. It also requires Fannie Mae and Freddie Mac to develop internal adjustments to account for crypto's market volatility and ensure that any risk-weighted reserves comprised of crypto do not compromise underwriting standards. That's a pretty tall order. How do you allow them to use Bitcoin basically as a reserve asset for borrowing while at the same time adjusting for the volatility of something that could drop 50% overnight? I just don't know how you do that. But under the directive, both enterprises must submit their assessment proposals to the board of directors for approval and then to the FHFA for final review. We'll have to see what those proposals look like before we pass judgment, but they got a pretty small needle head that they got to thread there. All right, let's shift gears over here to the big one. Trump is considering naming next Fed chair early in a bid to undermine Powell. And it's that last bit there, a bid to undermine Powell. That is what markets are reacting to here, a more dovish Federal Reserve. Let's see, who is he considering replacing him with? President Trump's exasperation over the Federal Reserve's take-it-slow approach to cutting interest rates is prompting him to consider accelerating when he will announce his pick to succeed Jerome Powell, whose term runs for another 11 months. In recent weeks, the president has toyed with the idea of selecting and announcing Powell's replacement by September or October, according to people familiar with the matter, of course. One of these people said the president's ire toward Powell could prompt an even earlier announcement sometime this summer. Trump is considering former Fed Governor Kevin Warsh and National Economic Council Director Kevin Hassett, according to people familiar with the matter. Treasury Secretary Scott Bessent is being pitched to Trump by allies of both men as a potential candidate. Some of these people said. Other contenders include former World Bank President David Malpass and Fed Governor Christopher Waller, all doves. These guys are all policy doves because the new chair wouldn't take office until next May. Announcing the pick this summer or fall would be far earlier than traditional 3 to 4 month transition periods. An earlier announcement could allow the chair in waiting to influence investor expectations about the likely path for rates, like a backseat driver attempting to steer monetary policy before Powell's term ends. When asked if Trump was entertaining an earlier Fed chair announcement, the White House said the Fed should pursue a growth-oriented monetary policy. In other words, more dovish. Zerp and Burr, lower rates, print them dollars, prop up my bubbles. Look, guys, all of this story, it's all based on the premise that interest rates are too high, that monetary policy is too tight. Well, I've said this before on this channel. This tight monetary policy, is it in the room with us now? Because I sure as hell don't see it. Look at M2 money supply. All right, this is all the checking accounts, CDs, and savings accounts, basically all the money in circulation. And we are currently at $21.944 trillion in circulation. Now, in October of 2023, when we hit our low, post-COVID low, we were at $20.55 trillion. So where did this nearly $1.5 trillion of new money in the last year and a half, where did it come from? If we have tight monetary policy, if financial conditions are indeed restrictive, then why are the banks loaning into existence more than $1 trillion in just a couple of months? And look, we're almost back to the high we were at before all of this started. Right before the effects of quantitative tightening started being felt, the money supply peaked at 22.05 trillion, and we were higher than that level just a few weeks ago. At the end of April, we were higher than that level. So all of the Fed's monetary tightening has been undone by this private credit bubble and all the banks loaning this money into existence. If interest rates were restricting growth and restricting lending and borrowing, then we wouldn't see this happening. In other words, we don't need looser monetary policy. We just don't need it. This is going to bring inflation back. And honestly, this has all been going on, all this money supply growth. I've used this analogy a couple of times. We've got banks and private credit and private equity are standing on a tree branch. They're dancing, swinging around back and forth, up and down, and they're moving further and further out onto that tree limb as Jerome Powell has been sawing into the branch. That is quantitative tightening happening simultaneously with this immense credit expansion that's going on in private credit. It's not going to end well, but we certainly don't need to have more Zerpenber in order to compensate for that. Honestly, I see this happening because everybody thinks the low interest rates are going to come back, and they think the Fed will ride to the rescue, and so they can get away with it. Meanwhile, we got Micron reporting earnings, and it was a big earnings and revenue beat, and they issued a strong forecast. The AI data center bubble continues. Micron reported better than expected earnings and revenue on Wednesday and issued a forecast that also topped analyst estimates. The stock initially popped and extended trading before paring most of its gains. Data center revenue more than doubled in the third quarter, Micron said, and total sales jumped 37% from $6.81 billion a year ago. The company has been seen soaring demand in the high bandwidth memory, or HBM, market due to artificial intelligence booms. People need that high bandwidth memory to go along with their NVIDIA GPUs at their data centers so their chatbots can tell us to glue our pizza together. And well, Micron stock, it was up about 5% after hours last night. It has given back a lot of those gains, still up about 2% ahead of the opening bell here this morning, trading at $129.75, up about $2.25. Meanwhile, we got to talk about this because this guy is just going to be, I don't know, this is fertile content soil for the foreseeable future. This lunatic that looks like is going to be taken over in New York City. A primary win by pro-rent freeze Mamdani knocks shares of Flagstar Bank on the New York City market exposure. Flagstar Bank, you guys might remember that one. It was a different name not too long ago. Let's see if anybody recalls this story. Shares of New York regional bank Flagstar slid nearly 4% on Wednesday after the apparent victory of Zohran Mamdani, or ZOC as I like to call him, in the New York City Democratic mayoral primary. Flagstar is the rebranded name of New York Community Bank. Remember that one? The one that almost failed last January, which came under pressure in 2024 in part due to its real estate exposure. Former Treasury Secretary Steven Mnuchin led a $1 billion investment into the company in March of that year. Mamdani, who is now the likely favorite to win the general election in November, promised to freeze rent increases in stabilized units during his campaign. The New York City mayor has the power to appoint representatives to a regulatory board that oversees rent-controlled apartments. A pause on rent increases could hurt the profit profile of multifamily rental properties. You guys remember that is what almost failed the New York Community Bank last year. It was those rental properties and huge losses on loans to rent-controlled apartment buildings in New York City that almost torpedoed that bank. Steve Mnuchin came in with $1 billion and rescued that bank, but really all they did was delay the problems. They changed the name to try to rebrand it. Now it's called Flagstar, one of their former subsidiary names. And look, this guy's talking about more price controls on rents in New York. And the funny thing about price controls is they don't work ever. Price controls lead to shortages because they interrupt market signals about the availability or scarcity of whatever it is they're pricing, in this case, housing. And we've seen this because of the increases in rent controls in New York City over the last few years. People can't make money renting out apartment buildings in New York City. And so a lot of these buildings are sitting largely vacant. Maintenance isn't getting done. They're not meeting standards for Section 8 housing. And so they're just not renting the apartments because they're not worth investing the money into them to get them up to the point where they can rent. And so they're just sitting there. And of course, they're not paying the loans if they're not getting any income from the rentals, which means there's fewer apartments available for people to rent. And what happens to prices when there's less availability? It tends to push prices higher. And oh, look, all the people we're supposed to be helping are the ones we're actually hurting with our stupid socialist housing policy. Stop me if you've heard this one before. And well, New York City real estate stocks across the board were getting clobbered yesterday. They're talking about government-run grocery stores in New York City. Wow. That's going to be great. This new socialist that's in charge over there. If you like the way they run the Department of Motor Vehicles, well, let's put those same people in charge of making sure you have access to fresh, not moldy produce. And I'm sure it's going to be just a great government run food store, just like the ones in the Soviet Union that went so well, right? Remember, was it Boris Yeltsin was actually in tears when he saw an American supermarket because, like, oh my God, there's so much food for sale here at our government run supermarkets in Russia. We don't have anything to eat. Yeah, okay. All right, good luck with that. Flagstar Bank down about 3.8% yesterday. It's bouncing back about a quarter today. But I tell you, being a landlord in New York City was a thankless job to begin with. I would not want anything to do with that city for several years now, guys. It's get some popcorn. It's not going to be fun, but it won't be dull. I can tell you that. Meanwhile, China is still choking exports of rare earths despite a pact with the U.S. Just a reminder, guys, that this trade war is always just one Truth Social post away. And well, I wouldn't be surprised to see that in the next couple of days if this story is accurate. 2 weeks after China promised the U.S. it would ease the exports of rare earth magnets, Chinese authorities are dragging out approvals of Western companies' requests for the critical components, a situation that could reignite trade tensions between Washington and Beijing. Western companies say they're receiving barely enough magnets for their factories and have little visibility on future supplies. Firms are waiting weeks as Chinese authorities scrutinize their applications, only to be rejected in some cases. And applications for raw rare earths, which are used to make magnets, are rarely granted. As a result, Western companies are concerned that the shortages could soon affect manufacturing. Companies are so desperate for magnets that they're opting for expensive air freight whenever licenses are granted to prevent costly production shutdowns. Some manufacturers are experimenting with workarounds that would allow them to make their products without the most powerful magnets. It's a hand to mouth, the normal supply chain scrambling that you have to do, said Lisa Drake, vice president overseeing Ford's industrial planning for batteries and electric vehicles earlier this week. Although she said the situation had improved, the scarcity of the rare earth magnets is forcing Ford to move things around to avoid factory shutdowns, she said. And so any day now, we could get another True Social post that could reignite all the tariff talk. And hey, we're still, what, a week and a half away from the deadline for getting trade deals done. I don't hear a lot about trade deals these days. I don't know about you guys. I go looking almost every day. Well, we'll see how this one turns out. And last but not least, we got to talk about this one. BlackRock deepens push into private investments for the masses. Wow, these BlackRock guys, they're so generous, aren't they? Look, they're practically philanthropists here. Oh, private investments for the masses. It sounds so great. Right up until you realize the reason they're selling this crap to the masses is because the elites don't want it anymore, and they've got to get it off their balance sheets before everybody figures out it's not really worth anything. BlackRock is accelerating a push into private investments by including them in funds for 401k retirement plans. One way or another, guys, they are coming for your 401k. If they don't outright seize it, they will park garbage assets in it. The world's largest asset manager plans to offer a 401k target date fund with a 5 to 20% allocation to private investments, depending on an investor's age, in the first half of 2026. A step toward that goal, BlackRock is expected to say Thursday that it is providing the public and some private investments for a 401k target date fund offered by Great Gray Trust, which offers 401k investments. Firms that specialize in privately held debt and equity investments see the $12.2 trillion market for 401k type retirement plans as a way to reach the everyday investors that are crucial to their growth. BlackRock, which manages $500 billion in target date funds, is the biggest such provider yet to announce that it will make private investments available. It will be up to employers to decide whether they want to add them. You notice how BlackRock's like, we're just offering this, I might say, to willing buyers at fair market value, right? Kind of like John Told from, what the heck was that movie? From Margin Call? Nowhere in this article does it mention how private equity firms have been using net asset value financing and Ponzi-like shell games to move these things around to avoid finding out what they're worth. They don't talk about payment in kind being used to extend these zombie companies' debts so they can survive just a little longer until they find hopefully somebody to buy this stuff with probably your pension or your 401k. They don't talk about any of this. No, they just say we're bringing it to the masses. We're making it available. And it's up to the employers to decide if they want to offer them or not. Guys, know what is in your retirement. I can tell you the phone calls are going to start happening. Investment managers, financial advisors, they're going to start calling up. They say, hey, we have this new alternative asset fund available to you. It's got private investments and you can get in on the ground floor because they're just making these things available for the first time. They are looking for bag holders and they have got their sights set on your retirement. Be careful with this, guys. This all over Wall Street, I see this crap is being pushed. And guys, I just want to say thank you very much to Robert Feeds the Machine. What's going on, Robert? He says, rest in peace, dollar. Don't hold Chuck E. Cheese tokens. Well, I don't know. Are those Chuck E. Cheese tokens holding their value as well as the dollar is? I don't know. And maybe we should tell all our clients to put everything they've got into Chuck E. Cheese tokens or Melon Coin or is what. Look, the dollar heading lower here, 97.3 this morning, hit 97.00. All I can tell you guys is a weaker dollar and prospects for lower interest rates, rocket fuel for gold. All right. And gold is kind of taking a break for the last month and a half or so. But while gold has taken a break, we've seen some of that safe haven demand just move into platinum and move into silver as those ratios have come down. That tells me the safety trade that is driving this big move in the gold price for the first beginning, last year and a half, if you will, the beginning of this year also, that is still alive. As soon as gold and silver catch up to within striking distance or to within a more normal ratio, I have every expectation that gold will continue to rise up with that. And look, for what's coming, guys, I just don't think there's enough gold in the world for what is coming. Everyone across the board, Europe, China, the US, everybody is making dovish monetary policy moves. And it's like we all forgot about the inflation of 2 years ago. It still has not gone below 2% for a day. Not one day have we seen an inflation rate below 2%. And yet they're all declaring victory and ready to they're already working on the next round of inflation. Better hold some gold. I like the shiny. Thank you, Robert, for feeding the machine this morning. Madison Hypes, thank you for supporting the channel. Says bullish on the 30-year treasury. Thanks for the show. No, I'm not. I'm not bullish on long-term treasuries. I'll tell you why. The Fed only controls the short-term interest rates. Those, the overnight rate. The 1 month will move with that overnight rate. Maybe the T-bills, the 2, the 6 month, they might move lower along with it. But the long end of the yield curve, the Fed does not directly control that. Now, they can influence it. They can print money and buy those things. That would drive their price up and their interest rates down. Or they could sell them, crashing their prices, which they're not going to do that, but they could. But the Fed does not directly control the long end of the yield curve. And if we're still seeing gold prices rising like this, if we're still seeing stocks at all-time highs, virtually every asset class at all-time highs, that is not economic prosperity. That is inflation being manifested in higher asset prices. And if we see interest rates cut, the short-term interest rates cut, the market is going to start to think inflation is going to come back, correctly so. And that's why if you go back and look when they started cutting rates last fall and ahead of the election, that's when gold really started to run. That's when longer-term interest rates started to move a lot higher. So I think what could happen here with this 30-year treasury, I think we're probably going to see the interest rate on that move higher, even if the Fed cuts. Because when the Fed cuts, it could cause people's inflation expectations to rise. And with higher inflation expectations, they demand a higher return in order to lock up their money for 30 years. So it's a little counterintuitive, but you could see the long end of the yield curve rising even as the Fed is cutting. Now, the downside or the flip side to that trade is if the Fed were to start up QE again and they start buying the long end of the yield curve, that would take that interest rate down, in which case the 30-year treasury would be a good investment in that. But no, I'm not touching the long end of the yield curve here. I don't think the Fed's rate cuts are going to have the desired effect on target there. And this whole sell America trade, if we see the tariff worries come back and everybody starts freaking out and dumping the dollar again, we're going to see those interest rates start to move higher as people sell American assets and look to park that money in gold also. So I'm not crazy about the long end of the yield curve just yet. Thank you, Madison, for supporting the channel. Nashville Pasta Man says, can I borrow against my fart coin? How about my Trump tokens? Now we're thinking outside the box, Nashville. I like the way you're thinking. This guy's got FHFA director written all over him right there, the way you're thinking. why not treat yourself, right? Borrow against your illiquid garbage shit coins and then, use it to buy a house at overly inflated prices. And then we'll take that debt, package it up into an MBS, sell it to your retirement. And then when your fart coin goes down and when you can't make the payment on your house and you lose house, your retirement goes down along with it. It's nice. At the end of the day, all the people that are doing this, they're collecting their fees. They don't care. You're just robbing yourself if you do this. So, yeah, Pasta Man. I was shaking my head when I heard that one yesterday. And look, I like Bitcoin more than you do, probably. And even I looked at that FHFA story and I was like, hell no. I did not like the looks of that one bit. Thank you, Pasta Man, for supporting the channel. And thank you, Gordon Guano, who says, read the brown paper fart coin to the moon. Yeah, sorry. Not a big fan of the fart coin or the AI chatbot that pumps it or the guy behind that AI chatbot that pumps it. Maybe one day I'll tell that story, maybe not. Uh, but yeah, fart coin. Yeah, we need dovish monetary policy. We got fart coin, crypto tokens named after flatulence and meme tokens and rug pulls, things people know are going to be rug pulls, all rocketing. And they're talking about, no, we need more money in circulation. All right, yeah. We need a rate cut like we need a hole in the head. Thank you, Gordon Guano, for supporting the channel, sir. I appreciate that very much. Chris Bot. Chris, are you a bot? Chris Bot says, are Beanie Babies pristine collateral? Hey, if we're using Bitcoin, I mean, I think Bitcoin's better than Beanie Babies, but Beanie Babies notoriously volatile. I can't I can't argue with the logic. Maybe you're taking it 2 or 3 steps further than Bitcoin, but I see what you're getting at here, guys. Bitcoin's just too volatile to be used as a reserve asset for mortgages. I mean, look, if you're using money and you're using discretionary income and you can ride out that volatility up and down through crypto winter, that's been my approach. Good for you if you can do that. Make sure you're not investing any money that you're going to need to make your payments on your bills during the winter. Like you got to have enough set aside to get through winter. But mortgage finance doesn't work that way, man. You can't take a 30, 40, even 50% decline in an asset's price backing up. No, no, stop it. Stop it. Go home, Federal Housing Finance Administration. You're drunk. Beanie Babies, Fartcoin, same thing. Thank you, Chris Bott, for supporting the channel, sir. Tell me how you guys really feel about this Bitcoin mortgage thing without actually telling me. Anyways, guys, I just want to say thank you very much for having your coffee with the Melonheads this morning. Thank you guys for all the super chats. I appreciate the support of the channel very much. Just a reminder to my magnanimous Melonheads on YouTube and Patreon, we're going to be doing our weekly get-together on Sunday evening this week because I'll still be on vacation Friday during our normal time. I'll be posting that later this week. Thanks again, everybody. I will be back tomorrow morning once again. Don't forget that like button and that subscribe button on the way out. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.